Welcome to another episode of My Name's Jose Najarro, and today we're going to take a look at my stock account. We're going to do a quick review of how it's doing, what are some new things I've added, what have I removed, and what are my steps going forward. Like always, I have my buddies Bull Solo and Darth Bear, but on this episode, they're not going to do anything. They're just going to stand up here and look pretty. Another good thing is today Star Wars is releasing, so you can tell by my sweater that I am ready to go see the movie. But I just wanted to do a quick video before I head out. So let's get started. Alright, so just to get started about this video, this is a brand new account. It started in early of November 2019, so it's only about a month and 2 weeks old. This is me showing how I would invest while the market is at all-time highs. In this account, I'm depositing about $400 every 2 weeks. This account will be one that matches my YouTube videos. So if you guys have seen my YouTube videos, I talk about companies that I would buy or sell. And to put my money where my mouth is, I do these videos. I made this account to match my YouTube videos. The account originally started in November 8th, I think, with $15,000, and right now it's sitting at $16,876, so almost $17,000. And I'll show how it got there. Some of it has to do with that deposit that I'm making, and like I said, right, time lapse is right now we're about a month and 2 weeks, and I'm also going to do a comparison on how this account was doing compare if I was just investing with the overall market. So we can see here in 11/18 I made a 377 deposit, in December 3rd of 432, and December 16 431. So I'm making sure every 2 weeks I deposit money, and that alone has helped me grow this account pretty quickly. So it's definitely good to see that if you keep depositing money into your account, it's definitely the easiest and the best way to make sure you're investing you're investing in your future. So these are some of the rules I'm following. The first thing is to have money in the market at all times. So even though the market is at all-time highs, I still believe that I should have money in the markets to make sure it grows. But I am following a bit of rules. Like I'm having cash. I'm having some cash position ready just in case if things go south. Since I originally started the account at a small $15,000, I want to diversify between companies. So you're going to see my full positions are usually about 1,500 at most. And for big caps and for mid and small caps, they're usually no greater than 750. And since I'm mainly into tech stocks based on my education base, I do a lot of techie stocks. I use ETFs outside of the tech world to diversify a bit. So these are some of the rules I'm following right now. So this is how I want my portfolio to see. So these values don't add up to 100, and that's okay. These are just like the minimum or the maximum values that I want to have. So large cap companies, these are companies that I do through my the large cap, mid cap, and small cap are companies that I do individually. So large cap, I want this to always be greater than 25% of my portfolio. Mid and small cap, I want this to be no greater than 15%. ETFs, I want these. So ETFs could be ETFs of large caps, of mid and small caps. But like I mentioned, these are usually outside of the techie world. These are, you can see, a more consumer based or some other sector that I don't follow as much. And I want this to be greater than 20%. Cash or short-term bonds, I want this to be at least 20%. So I want to have at least 20% of cash ready at hands, or short-term bonds. You're going to see I do have a short-term bond of a 3-month bond, so that's super short-term. So to me, I consider that cash. And then others, there's others, REITs, long-term bonds, commodities, and metals. I don't want this to be more than 10%. All this adds up to 90% of my portfolio. So there, for example, large cap, it can be greater than 25, so that can be up to 35, right? This could be a lot greater. Mid and small cap can actually be 0. I just don't want it to be greater than 15. So I just want to be diversified in different matters, and this is how I want my portfolio to look. But it takes time to build it up to this format. So first, let's start off with my cash position. So here in my right, you're going to see all my positions, and we're going to look at it through each slide on where we stand. So the first thing is we're going to talk about cash, and we can see the cash is actually the red highlighted. And right now I have about $4,700 of unused cash, which is about 28% of my total account. So remember, I want 20%, not 28%. So I need this to drop down to about $3,400 in cash. So I still have about $1,300 to spend. But at the moment, I also want to diversify with time. So I'm adding a little bit here and there every so often. If you can also see the other thing, within that 4.77, that's made up of about 2.7 in cash, and I have about $2,000 in an American Express bond. So this American Express bond matures in February 3rd, so that's 3 months away from now. So like I said, it's very short term, and it's a 2.2% interest bond. So I just have that amount right now. This is actually a big change from the last month when I did my first video. Last month I was sitting at about $7.7 thousand in cash, and I made a big change. I dropped it down to 4.7, and I started getting that money to work. The next thing we're going to talk about are my ETFs. So these are the ETFs that I have, and these are going to be the ones in blue. So for ETF, I have XLY, and I have VBC, I have XLY, VCR, BTC, and Berkshire Hathaway. The reason I consider Berkshire Hathaway an ETF is because the company as a whole is diversified into different companies, and I know the companies is diversified. Berkshire is diversified mainly in Apple. I think Apple is like 20% of the company's thing. Then it has banks and airplane transport. So those alone, I think, make up over 50% of the company's portfolio. So that's why I consider Berkshire one. And I don't invest in Apple, I don't invest in banks, and I don't invest in airplane transport. Then we have VCR. So VCR has companies like, actually I'll talk about VCR in a bit. Then there's companies like, I have VDC, which is a Vanguard ETF that has Procter & Gamble, Coca-Cola, Pepsi, and Walmart. Then I have VCR. VCR has Amazon, Home Depot, McDonald's, Nike, Starbucks, and XLY is a new position that I opened up since my last video, and it is very similar to VCR, not VDC. I know I have VDC here, but it's very similar to VCR, which has Amazon, Home Depot, McDonald's, and Nikes. And we'll take a look in the next slide why I opened up more XLY instead of increasing my position in VCR. But right now, my ETFs make up about $3,300 of my account, which is about 20% of my 19.8% of my account. I need this to make this at least 20%. So I can probably buy one more share here or there of one of these to increase my portfolio exposure on ETFs. Last time I was sitting at about $1,800, so I almost doubled what I had last month. So you can see I'm getting this money working, and I'm getting it in there in the market. So these in ETFs, held position means I did not open a new position or I did not increase, and that's VDC. I did have a new position, XLY, and remember how I mentioned that VDC and XLY are similar? We can see here they actually have the top 10 companies are almost identical minus the 10th one. XLY has GM and VDC has Tesla instead for the number 10 position. But that's not the reason I chose it. The reason I chose it is because XLY, I definitely like Home Depot right now. I definitely like McDonald's right now. Nike, Starbucks, and Lowe's are all companies I like. Even though VDC has these positions as well, XLY has a heavier weight on them. So you can see Home Depot in VDC is sitting at about 7.5% of the total weight, while on XLY is sitting over 10%. McDonald's in XLY sitting at 6.3%, where McDonald's in VDC is sitting 4.6%. You can see throughout Nike in XLY is 5.3%, while Nike in the other one is only 3.9%. So I honestly like that these companies have a higher weight value on XLY, and that's why I opened up XLY instead. I did increase positions in VCR and Berkshire Hathaways, and that's what you see, right? My portfolio went from 11.8% in ETFs to now sitting at almost 20. It's at 19.8. So my idea right now for ETFs is to buy more more VCR, which is the one I don't have here. VCR is the one that has Procter and Gamble. Sorry, I meant to say to buy more VDC. Oh, hold on, sorry. I want to buy more VDC, which has Procter and Gamble, Coca-Cola, Pepsi, and Walmart. Not the ones that I have here. So I want to increase my position there because XLY and VC and consumer and VDC are too heavy right now. So I just want to increase my position in Procter and Gamble, Coca-Cola, Pepsi, and Walmart and Costco because I have too many in Amazon, Home Depot, McDonald's, and Nike's. All right, so next let's take a look at my small and mid cap. So my small and mid caps are, for those that don't know, right, stocks are broken down into three different categories, three tiers. Large cap, which are companies that are over $5 billion worth. We have mid cap, which is between $2 billion and $5 billion, and we have small cap, which is less than $2 billion. Right now, my mid and small cap consist of Macy's, GameStop, Opera, and Jerash. I have done a video on all these companies. A video on GameStop is coming up, but let's talk about how it's sitting right now. Small and mid cap are sitting at about $1,500 of my portfolio, and it's only 8.6%. I don't want this to be higher than 15%. So I'm still within my range. I could increase it, but I don't want to increase the positions of my current. I don't want to increase the size of my current positions. I want to look at more companies and buy more into them instead of increasing my current positions. So last time I had about 1.2 and it was sitting about 7.5%. So you can see in this past month I have also increased my size in my small and mid cap. So here I held positions on Opera. I didn't buy anything else there. I did open up a new position in Jerash, and I increased positions in GameStop and Macy's. So that's pretty good. Opera and Jerash are very small caps, so those are sitting at about $250, where GameStop and Macy's are both mid caps, and those are sitting closer to the $500 mark. So if I wanted, I could increase the positions on all of them, but at the moment I do not. Next, let's talk about my big caps. So these are my boys right here. I have AMD, Activision, I have Boeing, Cisco, Disney, Intel Core, Microsoft, Starbucks, and Twitter. I have done video on all of these at the moment, except Boeing. Boeing is a really brand new position, and I'm going to do a video on that one as well soon. Right now, my bid caps are sitting at about $6.8 thousand, and it's about 40% of my portfolio. I want this to be always above 25%, so I'm above that mark. That's definitely great. Last time it was sitting at 5.6, so you can see, again, I have increased my positions in the past month and getting that money to work. I held positions. These are positions I didn't increase: Twitter, Microsoft, Disney, and AMD. I opened up a new position on Boeing, and I increased my position on Activision, Starbucks, Intel, and Cisco since my last time here. Right now, my idea for big caps are good. There's no change I should do, and I'll keep focusing on either new companies, new ETFs, new companies. But I do feel like I should focus more on some more ETFs before I jump back to big caps, to individual big cap companies. And maybe I can diversify some more into commodities and metals. But this is something I have to think very, very thoroughly throughout before the next video, and seeing which road I want to pursue. Maybe, who knows, maybe like 3-4% in gold, just to hold some other form of metal and some other form of diversification. So this is the overall position, right? Let's just go in order. Let's just start off with cash positions, right? I'm not making any money in cash positions, right? Because these are low risk, low returns. Then we're going to talk about blue. Blue is my ETFs. Berkshire is up 2%. VCR is up 2.4%. VDC is up 2.42%. And my new position on XLY is open up 1.2%. So you can see all my ETFs, even though they're diversified among different companies, they're all giving me about that same 2.2% return. And that's pretty much, I would assume, if I look at SPY throughout the times that I bought it, between then and there, I would see similar returns. So I'm pretty sure these are kind of mimicking the market, and we can see the SPY, since my last thing, would probably have returned somewhere about 2.5, 2 point something percentage return. Next, we can see why I love to do individual companies and why I love to really study the company. Let's start off with my small and big caps. GameStop. GameStop is up 6%, so way higher than that 2% average, 2.something% I was getting from my ETF. Garage is up. Garage is actually sitting at negative 0.62%, so not much return there. Actually, a small loss there. Macy's is up 8%, a lot higher than that 2% average. Opera is up 7.2%. So we can see, right, percentage-wise, these are doing a lot better. Next, let's take a look at my big caps. We have AMD sitting at a whopping 16.8%. We have Activision at a big 10%. My new Boeing position, right? This Boeing is very new, so I expect it not to move anywhere in the next few days and the next few weeks, and it's sitting right now at a loss at negative 1.7%. And this is actually my biggest loser right now, which is not that bad. Cisco is up 4.56%. Disney is up 5.73%. Intel is flat, is negative 0.76%. But you can see, right, that Microsoft up 7%, Starbucks up 5%, Twitter up 9%. These all my individual companies are up a lot higher than the average from the ETF. And those that are losers right now are pretty much break even points, which I think it's great news. Another thing is this total was taken December 18th. So Cisco jumped up a lot today in December 19th. So this Cisco is actually giving me more returns. I think at this price is sitting at 46. Cisco, I think, ended at 47 point something. Let's take a quick look real quick to see what Cisco ended at. So like I said, I'm 1 day behind, but that 1 day can make a big difference. I have Cisco. Yeah, Cisco is actually at 47.97 cents, so almost $48. So that's definitely a nice percentage more gain here. So you can see my individual companies are doing a lot better than those ETFs. And that's why, like I said, I enjoy reading these companies. But the portfolio is only up for 1 month right now. So there's still a long way. This is a long-term race. Hopefully in the next 15 years, I can say the same thing. All right, so how does it look? Large cap right now, I'm sitting at 40.3%, so that's greater than the 25%. That's good. All right, I'm not going to mess with large cap anymore. Mid and small caps, they're sitting at 8.6%, which is less than I need it no more than 15%. So that's also doing good. I do maybe want to start diversifying and start looking at more mid and small caps and adding a few more companies here and there. My ETFs are sitting at about 19.8%, and I want this to be greater than 20%. So you can see I need to add some more money into these accounts. And even though they give me pretty low returns compared to what I've seen in my individual companies, that's okay with me because I want to be diversified as much as possible. Cash and short-term bonds, I want this to be 20%, but it's actually sitting at 28.2%. So I have some more money to use. This I'm gonna go use it slowly over time. I'm not just gonna go all at once. I'm gonna use it maybe every day here and there by a position, or every week here and there by a position, until I finally drop down to that 20%. Others, REITs, bonds, commodities, and metals, I have 0%, and I don't want this to be more than 10%. So at 0%, this is fine. So right now my portfolio is looking to where I want it to be. We can see the most important thing is I need to use that cash that I have that is not working right now. So now this is probably the thing you guys want to see the most, is how my portfolio is doing to the overall market. So when I first started this with my last video, the account was at $15.6 $1,000. I had a 1.78 return of $149 plus. Right now, the portfolio is sitting at 16.8, almost $16.9,000, 4.9%, 4.09%, and I'm up $553 compared to yesterday. So that's pretty good. But let's see how I would have done if I would have just invested in SPY, right? Because what's the point of me doing all this work if the SPY could just have been a lot easier? I didn't even have to think about anything. So what I ended up doing here is down here I have the moments when I deposited money into this account. So I put 2.5 in the 7th, 12.5 in the 8th, and here you can see all the amounts. Then I took a look at SPY on those dates and determined how much return the stock market has given since those days and till December 18th. So these are the returns since 11/7/2019, since November 7th, the stock market actually has returned 3.7%. Since November 8th, it returned 3.4%, and so on and so forth. So now I determined how much my portfolio would have been if I was sitting just in the stock market. So if I was just sitting in SPY, my account would have been 6,879. So that's 6,879. And right now, with my current portfolio, I'm actually sitting at $6,876. So I'm actually losing to the market by $3, or overall, I'm losing to the market by 0.02%, not by 0.2%, by 0.02%. I'm losing to the market by $3. $3.50 is what I'm losing to the market. But remember one thing, I still have about $4,000 that is not being used. So that's what's making me pretty excited, right? What if I had those extra $4,000 working in the market? Then this return would be much higher than the SPY. But I'm waiting for some great returns to be. So I'm happy that right now I'm pretty much break even with the market, and I'm not using the same amount of capital, right? I'm $4,000 less. I'm using 28% less capital, and I'm still maintaining the same returns. So that's a great way for it to see it. This thing right here from Fidelity is telling me that I'm up 4.09%, but Fidelity does this weird thing that they give you the amount that you're making with non-cash assets. So you remember how I have the $4,700 in cash or short-term bonds. This is not including that, so it's saying 4.09% on the money that's actually invested in actual assets right now. So that to me is giving me good. I'm getting good reviews right now from this. So this is positivity going in the way I'm investing. So like I said, I hope you guys enjoyed this episode. Let me know what you think. Let me know if you guys have any questions. And hopefully you guys are enjoying this videos. Take care. See you next time. And I'm off to go see Star Wars. So may the force be with you. And hopefully this video is up before I leave. Take care, guys, and have a good night.